Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance. Today we are diving deep into Linkers Industries Limited's latest annual report for the fiscal year ending the 30th of June 2025. And trust me, there are some eye-opening numbers and very interesting risks to talk about. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. Linkers Industries Limited, for those unfamiliar, is a company that manufactures wire and cable harnesses. Think of all the wiring bundles in your appliances, your car, or industrial equipment. That is what they make. Their operations are primarily based in Malaysia. Now, let's get into what this report tells us about their current situation. This is an annual report filed with the US Securities and Exchange Commission, or the SEC, meaning it is a yearly checkup on how the company is doing. They are obligated to file this because their shares are traded publicly. The report covers their financial performance and gives us a look at their business operations and future prospects. Let us start with the top line revenue. For the year ended the 30th of June 2025, their revenue was around RM 22.4 million. That is about 5.3 million US dollars. Now, if we compare this to the previous year, the 30th of June 2024, the revenue was almost identical, RM 22.4 million. So, not much change there. This stability, in a way, is a bit concerning when you look at the other numbers. It means they are not really growing their sales significantly. Moving on to the cost of sales, which is how much it costs them to make their products. This also saw a slight increase of about 2%, reaching RM 20.6 million for 2025. The report mentions this increase is partly due to a new minimum wage policy in Malaysia. This means their costs are going up, but their revenue is staying flat. And this is where we see a significant squeeze on their profitability. Their gross profit, which is revenue minus cost of sales, dropped by 18.5% for 2025. It was RM 1.8 million, down from RM 2.2 million in 2024. This means for every dollar they sell, they are keeping less money after paying for the materials and direct labor. This is not a good sign for operational efficiency. Now, let's look at their general and administrative expenses. This is where they spend money on things like salaries, office costs, and professional services. These expenses saw a massive jump of 83.7%, going from RM 3.3 million in 2024 to RM 6.1 million in 2025. The report points to a big increase in professional services fees. This suggests they hired a lot of external consultants, lawyers, and auditors, likely related to their initial public offering, or IPO. While an IPO can bring benefits, these upfront costs are substantial and are eating into their profits. When we put all this together, their income from operations, or rather their loss from operations, widened considerably. They reported a loss from operations of nearly RM 4.8 million in 2025, compared to a loss of RM 1.5 million in 2024. So, the business itself is losing more money than before. And this trend unfortunately continues to the bottom line. Their net loss for the year ended the 30th of June 2025 was almost RM 4.9 million. This is a significant increase from the RM 2 million loss in the previous year. Essentially, the company is losing a lot more money than it is making. Now, let's look at their cash situation. Here is something interesting. Their cash and bank balances saw a huge increase, jumping from about RM 3.8 million in 2024 to over RM 23.7 million in 2025. That is a massive gain. Where did this money come from? The report later reveals it is largely due to the proceeds from their initial public offering, or IPO. This influx of cash is crucial for a company experiencing increasing losses. Their receivables, meaning money owed to them by customers, decreased from RM 15.4 million in 2024 to RM 11.2 million in 2025. This could be a mix of good and bad news. It might mean they are collecting money faster, or it could mean they are selling less to customers who owe them money. On the other side, their trade and other payables, meaning money they owe to suppliers and others, decreased significantly from RM 12.1 million in 2024 to RM 8.1 million in 2024 to RM 8.1 million in 2025. This is generally a positive sign. It suggests they are paying down some of their short-term debts, and this is where the IPO really shows its impact. Look at the cash flows from financing activities. In 2025, they generated over RM 13.4 million in cash from financing activities. In the previous year, they actually used RM 1.9 million. This massive positive cash flow is primarily from the money raised through their IPO. This cash infusion is what is keeping them afloat and allowing them to cover increasing operational losses for now. However, it is crucial to look at their operating cash flow. For 2025, it was a negative RM 2.1 million. This means their actual day-to-day business operations are consuming cash, not generating it. And this negative trend has been worsening over the past few years. So, while the IPO cash is a buffer, the underlying business operations are a cash drain. Their investing activities, which typically involve buying equipment, remained modest, with only about RM 63,650 used in 2025. This shows they are not significantly expanding their physical assets right now. Now, let's talk about risks. Linkers Industries faces a lot of risks, and they are laid out quite extensively. A major one is their dependence on a very small number of customers. For the year ended the 30th of June 2025, their top 5 customers accounted for nearly 90% of their total revenue. If even one of these major customers decides to reduce or stop their orders, it would be devastating for Linkers. This is a huge concentration risk and something investors should be very wary of. Another key risk is related to their corporate structure as a holding company. While they operate in Malaysia, the parent company, Linkers Industries Limited, is in the British Virgin Islands. This can create complexities, especially regarding how money can be moved between the Malaysian operating subsidiary and the parent company. Any restrictions on dividend payments, for example, could impact their financial flexibility. They are also subject to regulations in Malaysia, but because they are listed in the US, they have to deal with US regulations too. The report highlights that enforcing legal rights or judgments against them in the US might be difficult because their main assets and directors are outside the EU. This is a common concern for foreign companies listed in the US. Notably, they are classified as an emerging growth company. This means they can take advantage of certain relaxed reporting requirements, which might mean less detailed information is provided to investors compared to more established public companies. While this can reduce compliance costs, it is something to be aware of. And here is a critical piece of current information affecting their stock. As of the 10th of March 2025, they received a notification from Nasdaq that their stock bid price had been below $1 for 30 consecutive business days. They were given time to regain compliance, which is a very common issue for smaller, volatile stocks. This indicates potential investor sentiment issues and could lead to delisting if not resolved. They have been granted an extension until March 2026, but this is a serious red flag. Given all these factors, the increasing shift from profit to loss, the dependence on a few customers, the operational cash burn, and the Nasdaq bid price issue, it is no surprise that the report warns about high stock price volatility. They explicitly state that you could lose all or part of your investment. My take on Linkers Industries Limited is that they are in a very precarious position. The IPO provided a much needed cash infusion, and that's a good thing. It buys them time. However, the core business operations are not profitable and are actually losing more money than before. The massive increase in general and administrative expenses, especially professional fees, highlights the cost associated with becoming a public company, but without a corresponding increase in revenue or profit, it further exacerbates their losses. Their heavy reliance on a handful of major customers is a significant risk that could unravel their business if any one of them leaves. The Nasdaq bid price issue is also a major concern that suggests the market is not valuing their stock positively at the moment. While they have a long history in the industry, they are not demonstrating growth or strong operational efficiency in their current financial results. Unless they can significantly improve their sales, control costs, diversify their customer base, and address the Nasdaq listing concerns, the future looks quite challenging. What is your take on these numbers and what they signal for Linkers Industries? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.